Thanks for joining us here on Gorgeous Graphs, where we explore financial concepts through clear charts and visuals. In today's video, we'll look at how the size of monthly contributions and dividend reinvestment affect the long-term value of a portfolio. The scenario begins with a starting investment of $10,000. On top of that, three levels of monthly contributions are tested: $100, $250, and $500. Each of these strategies is further split into two cases: one where dividends are reinvested and one where they are simply taken out as cash. The assumptions are simple and fixed throughout the 30-year period. The annual growth rate of the portfolio is 4%, while the annual dividend yield is 2%. For clarity, neither inflation nor taxes are considered in this model. As the animation unfolds, we see 6 different growth paths emerge. Portfolios with reinvested dividends, shown as solid lines, consistently outperform their non-reinvested counterparts, which are shown as dashed lines. Even at the same contribution level, the reinvested dividends compound to create a significant advantage over time. By the end of 30 years, the difference becomes dramatic. For example, at the highest contribution level of $500 per month, reinvesting dividends produces nearly $70,000 more than simply collecting dividends as cash. Even at smaller contribution levels, the compounding effect of reinvestment is clear and measurable. The key insight here is that both steady contributions and dividend reinvestment work together to accelerate portfolio growth. Small, consistent additions combined with the power of compounding can lead to far greater long-term wealth than relying on contributions alone. This chart demonstrates just how powerful the reinvestment decision can be when viewed over decades.